Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 February-March Paper 2-2, question number 4. This is paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. The total time limit given for this paper is 1 hour and 45 minutes. Since question number 4 is of 30 marks, ideally you should be spending about 35 minutes in order to complete this question. And in this video as well, we'll be attempting to solve it under 35 minutes. So without any further delay, let's get started. K Limited uses absorption costing at one of its factories. The product manufactured in this factory goes through 2 production departments, cutting department and the finishing department. The following budgeted information was available for the year ended 31st December 2023. So we have been given the overhead absorption rate right here for both the cutting department as well as the finishing department. Now the first thing we need to do is figure out the basis for this overhead absorption rate. Remember that our basis will be the higher of the budgeted labor hours and the budgeted machine hours. So for cutting department, we can see that clearly machine hour is the higher one. So the basis for overhead absorption rate for the cutting department will be machine hours. And for the finishing department, we can see that the labor hour is greater than the machine hour, which means that the basis for overhead absorption rate for the finishing department is going to be labor hours. Then a customer placed an order for 250 units in November 2023. The following budgeted information is available about the production of 1 unit. So we have been given the per unit direct material cost, direct labor cost for each of our department, and we have been given the machine hours. So this will be utilized when calculating our overheads for both the departments. Then we are told that the selling prices are set to achieve a profit margin of 40%. This profit margin of 40% will be utilized in order to calculate the selling price. Now we need to prepare a statement to show the total selling price for the customer's order. Remember that the total number of units is 250 units. So the first thing we can do is figure out the total cost per unit multiplied by 250 so that we get the cost of 250 units. Then use our profit margin of 40% in order to get the total selling price. Let's start the statement. We can first start with the direct material per unit. The direct materials we have is of 17.28. Then we can include our direct labor. And for direct labor, we need to include it differently for 2 different departments. So the first one we have is cutting department. And we are including the per unit direct labor. So for cutting department, we know that each unit requires 1.2 hours and the rate per hour is 11.50. It means that the per unit direct labor cost will be 1.2 times 11.5. This results in the value of 13.8. We then repeat the same process for the finishing department. We can see here that in our finishing department, each unit requires 3.1 hours and the rate per hour is 11.5. It means that the rate per unit is just going to be 3.1 multiplied by 11.5, and this results in the value of 35.65. Now we're done with the direct labor. We can now move towards the overheads. For overhead, again, we need to list it down separately for our 2 different departments, the cutting department and the finishing department. And for overheads, we always need to refer back to our overhead absorption rate. Let's take a look above. For our cutting department, the overhead absorption rate was 3.62 and the basis for this department was the machine hour. And in order to calculate the per unit overhead now, we just need to multiply the overhead absorption rate to the per unit machine hour. And the machine hour is given right here for cutting department. That will be 2.2 hours per unit. So our overhead per unit is just going to be 2.2 multiplied by 3.62. So we have 2.2 multiplied by 3.62, which results in the value of 7.96. We then repeat the same process for finishing department. For finishing department, the overhead absorption rate is 2.34 and the basis for this one is labor hour. So in order to calculate the per unit overhead, we just need to multiply this overhead absorption rate to the per unit labor hour. So direct labor is given right here. We are talking about finishing department And for that department, each unit requires 3.1 hours. So the required overhead per unit is just going to be 2.34 multiplied by 3.1. So 3.1 multiplied by 2.34, which results in the value of 7.25. Now these are all of our costs. We can calculate the cost per unit by adding all these values. So that's 17.28 plus 13.8 plus 35.65 plus 7.96 plus 7.25, which results in 81.94. Now we can calculate the total cost. So for total cost, remember that the total number of units for this one is 250 units. So we can just multiply the number of units to the cost per unit. That results in the total cost to be of 20,487. Now we just need to add profit to our total cost in order to get the total selling price. And for this one, we need to use our profit margin of 40%. So if the profit margin is 40%, it just means that from the total revenue, 40% of the revenue is our profit, whereas the remaining 60% is our cost. So now we have the value of total cost, which is why we will be using this 60%. So now we know that revenue times 60% will be equal to our total cost, which is of 20,487. This gives the total revenue or the total selling price to be 20,487 divided by 60%, which results in the value of 34,145. So that's our total selling price. Now let us also calculate the profit. Profit is just the difference between the selling price and cost. So that will be 34,145 minus 20,487, which results in the value of 13,658. That is all for the first part. Let's move towards the next one. We now have additional information. Actual production hours for the year ended 31st December 2023 were as follows. So we have the labor hours as well as the machine hours for both our cutting department and the finishing department. Total actual overheads were the same as budgeted overheads. Now we need to calculate the over absorption or under absorption of overheads for each production department for the year ended 31st December 2023. Alright. So we need to calculate the over absorption or under absorption for both the department. So this will be our working for the cutting department. This will be our working for the finishing department. And whenever we need to calculate the over absorption or under absorption, we just need to compare the actual overheads to our budgeted overheads. Let's start with the actual overheads. We were told that the total actual overheads were the same as budgeted overheads. So for the value of our actual overheads, we just need to calculate the budgeted overheads. And we have the overhead absorption rate, right? Remember, overhead absorption rate is calculated by dividing our total budgeted overheads by the hire of our labor hours or machine hours. So in order to get our budgeted overheads, we just need to multiply the overhead absorption rate by the basis hours. So for the cutting department, that will be 3.62 multiplied by 22,900. Let's write it down. So 3.62 times 22,900, which results in the value of 82,898. We then repeat the same process for finishing department. That will be 2.34 multiplied by 8,400. This results in the value of 19,656. Now we need to calculate our budgeted overheads, but now the budgeted overheads should reflect the actual hours. So we will still be using the overhead absorption rate of 3.62 and 2.34, but rather than multiplying it by our budgeted hours, we will now be multiplying it by the actual hours. So for the cutting department, that will be 3.62, and the basis for cutting department was the machine hour. So we need to now multiply it by 24,300. This results in the value of 87,966. We repeat the same process for finishing department. That will be 2.34. Now we need to multiply it by our actual labor hours, since labor hour was the basis for the overhead absorption rate of finishing department. So 7,900. This results in the value of 18,486. Now we just need to calculate the over absorption or under absorption. And in order to calculate that, we just need to compare the actual overheads to our budgeted overheads. Remember that if our budgeted overhead is less than the actual overhead, then this will result in under absorption. If the budgeted overhead is greater than the actual overhead, this will result in over absorption. Now for our cutting department, we can clearly see that the budgeted overheads is greater than the actual overheads. So this is the case of over absorption. We also need to calculate the amount for overabsorption. That is just going to be the difference. So 87,966 minus 82,898, which results in the value of 5,068. Then we repeat the same process for finishing department, but in this case we can see that the actual overheads is greater than the budgeted overheads. So this is a case for underabsorption. Again, the value for underabsorption is just going to be the difference between our actual overheads and the budgeted overheads. So 19,656 minus 18,486. This results in the value of 1,170. That's all for the second part. Let's move towards the next one. We now have additional information. K Limited uses marginal costing at another factory where a single type of product is made. The following budgeted information is available. So these are all the per unit values for the selling price, direct material, direct labor, and other variable costs. We know that the fixed costs per month are 38,500. Currently, the factory is producing 9,920 units per month. We now need to calculate both the total monthly contribution and the total monthly profit currently being made in this factory. So we can first calculate the contribution per unit. Remember that the contribution per unit is just the difference between our selling price per unit and the variable cost per unit. In this case, that's 42 minus 12 minus 18 minus 3, which results in 9. Now the total monthly contribution is just going to be the units per month, which in this case is 9,920, multiplied by the contribution per unit of 9. So the total monthly contribution is going to be 89,280. Now in order to get the total monthly profit, we just need to subtract the fixed costs. And the fixed cost given in this case is 38,500. So the total monthly profit is just going to be 89,280 minus 38,500, which results in 50,780. That's all for the third part. Let's move towards the next one. We now have additional information. The directors hope to increase demand by changing the selling price. They are considering the following two options. Okay, and in this case, we need to prepare marginal costing statements to show the monthly forecast profit rounded to the nearest dollar for each option. So let us first go over the information for option A. We now need to reduce the selling price per unit by 5%. So the previous selling price per unit was 42. Now the new selling price will be 42 reduced by 5%. This results in the value of 39.9. Then we need to increase production by 4,000 units on the current production level. So our new number of units will be the previous production level of 9,920 plus the additional 4,000 units. This results in 13,920 units. Then a commission of 0.25 per unit will be paid. So this can be categorized as variable cost. So we can add this to other variable cost. Our previous other variable cost per unit was 3. Now we also need to add the commission of 0.25. So this will be 3.25. Then overtime will be required on all units produced over 12,400 units and is paid at a premium of 25%. Let us calculate the overtime premium first. So we just have to refer back to our direct labor per unit, that is of 18. And now we need to calculate 25% of this value. So that will be 4.5. Now remember that all units produced over 12,400 units is paid a premium of 4.5. In this case, we know that we are producing a total of 13,920 units. So out of this, for 12,400 units, right here, we'll only be paying direct labor at its normal rate of 18. But for the remaining units, that's 13,920 minus 12,400, which is 1,520. And for these units, we will be paying the direct labor at its normal rate as well as this overtime premium of 4.5. So that's going to be 18 plus 4.5, which is 22.5. Then we need to cancel the current advertising campaign costing 8,000 a month. Since we are now cancelling it, this will reduce our fixed cost. The previous fixed cost per month was of 38,500. Now we are reducing it by 8,000. So this results in the new fixed cost to be of 30,500. Now based on these information, we need to prepare our marginal costing statement. So we can start with the total revenue. For this one, our selling price per unit is 39.9 and the total number of units is 13,920. So that will be 13,920 multiplied by 39.9. This results in the total revenue of 555,408. Then we need to repeat the same process for our direct material. Again, the total number of units is 13,920 and the direct material per unit will remain the same. There is no change under option A. So that will still be 12. This results in the total direct materials to be of 167,040. We can now move towards direct labor. And for direct labor, we need to consider two different number of units. So for 12,400, we need to multiply it by 18. For 1,520, we need to multiply it by 22.5. Let's write it down. So for 12,400 units, the rate is at the normal rate of 18. For the excess 1,520 units, we need to pay the normal rate as well as the overtime premium. So that is of 22.5. This results in the total direct labor to be of 257,400. Now, we also need to include our other variable costs. Again, the number of units is 13,920. And we calculated the new other variable costs right here to be 3.25 per unit. So we just need to multiply these two together. This will result in the total other variable cost to be of 45,240. Now we can calculate the contribution. So that is going to be 555,408 minus 167,040 minus 257,400 minus 45,240, which results in 85,728. Now we need to subtract the fixed costs. And the fixed cost given in this case, so we recalculated it again to be of 30,500. Now we can get our profit per month. So that is going to be 85,728 minus 30,500, which results in 55,228. That is all for option A. Now we need to repeat the same process for option B. So let's take a look at the additional information. We now need to reduce the selling price per unit to 41. So this will be the selling price. Then we need to increase production by 10% on the current production level. So the number of units in this case, we can start with the current production level, which was 9,920. and we now increase it by 10%. So times 1 plus 10%, which results in 10,912 units. Then we need to invest in more up-to-date machinery at a cost of 180,000. It is proposed to partly finance the purchase of the new machinery by borrowing 150,000 at 8% per annum interest. So now we also need to calculate the interest per month. That will be a part of our fixed cost. We know that the loan amount is 150,000. The rate per annum is 8%, but we only require the interest per month, which is why we divide it by 12. So that results in 1,000. This should be added to our fixed cost. Okay, the previous fixed cost was of 38,500. We now increase it by the interest per month. Then machinery is depreciated by 25% per annum on cost. Again, the depreciation, we need to figure it out per month again, because this will also be added as part of our fixed cost. We know that the cost of the machinery is 180,000. The rate for depreciation is 25%, but this is the rate per annum, and this will give the depreciation for the entire year. And we only require the depreciation per month, which is why we divide it by 12. This results in the value of 3,750. We again need to add it to the fixed cost. Then, as a result of improvements to machinery, the time each worker takes to produce one unit will be reduced by 8%, and a higher quality product can be made. Okay, so let us first calculate the total fixed cost. That will be 38,500 plus 1,000 plus 3,750, which results in 43,250. Then we need to reduce the direct labor hour per unit, and we need to reduce it by 8%. Okay, let's see. Previously, we were told that each unit requires 1.5 hours of direct labor. Now we are reducing this 1.5 by 8%. So times 1 minus 8%. This results in 1.38 hour. Now we also need to recalculate the direct material per unit. And in this case, remember that 18 is just the product of the direct labor hour per unit, which is 1.5, and the direct labor rate per hour. We need to calculate the direct labor rate per hour now. So that is just going to be 18 divided by 1.5, which is 12. So the rate per hour still remains the same. Now we need to recalculate the direct labor per unit. That is just the product of our hour per unit, so that's 1.38 now, and the direct labor rate per hour, which we just calculated to be 12. So this results in the value of 16.56. So that is all. Now based on this information, we need to prepare the marginal costing statement for option B as well. We can see that the selling price per unit is 41 and the number of units is 10,912. Let's start our statement. So we have the revenue. That will be the product of our number of units, which is 10,912, multiplied by the selling price per unit of 41. This results in the value of 447,392. Then we can move towards the direct material. There was no change in direct materials for this one. So again, the number of units multiplied by the previous direct material. So the previous direct material per unit was 12. This results in the total direct materials to be of 130,944. Then we can move towards the direct labor. Again, that will be the number of units multiplied by the direct labor per unit, which we recalculated to be 16.56. This results in the total direct labor to be of 180,702.72, so we can round it off as 703. Then we need to include the other variable costs. The other variable cost is not changing in this case. So again, the number of units multiplied by the previous other variable cost per unit, which was 3. So this results in the value of 32,736. Now we can get our contribution. So that is just going to be 447,392 minus 130,944 minus 180,703 minus 32,736, which results in the value of 103,009. Now we just need to subtract the fixed costs. And in this case, we recalculated the fixed cost right here to be of 43,250. Now we can get the profit per month. So that will be 103,009 minus 43,250, which results in 59,759. That is all for option B. Let's move towards the next part. Now we need to advise the directors which option they should choose. We need to justify our advice by discussing both financial as well as non-financial factors. So this is of 7 marks, so we need to have 3 comments for each of the options. Let's start with option A. So let's take a look at the given information. We are adopting these 2 options in order to increase the demand by changing the selling price. And for option A, we have now reduced the selling price to 39.9, whereas for option B, the selling price has only been reduced to 41. So the first thing we can say is that the greater reduction in selling price may increase demand, which might meet the objective. Let's write it down. So greater reduction in selling price may increase demand. Again, let's take a look at the information. For option A, we have overtime. And whenever there is overtime, we can always question whether or not the staff are prepared to work in overtime conditions. Let's write it down. So are staff prepared to work in overtime conditions? Then again, let's take a look at our information. For option A, we are also cancelling the current advertising campaign. So we can question whether or not this cancellation of the advertising campaign will affect our demand. So will cancelling the advertising campaign affect demand? Now we can move towards option B. For this option, I think it has the highest profit per month. It's 59,000 for option B, and it's 55,000 for option A. So the first thing we can write is that option B is the most profitable option. So it is the most profitable option. Now let's take a look at the information. For option B, we are also borrowing a loan of 150,000. So whenever there is information regarding loan, we can always question whether or not collateral will be required. And let's see, the next point is that we are now investing in a more up-to-date machinery. So we can also question whether or not the installation of this machinery can cause a delay in production. So those will be our other 2 comments. Let's write it down. So will collateral be required for the loan? And will installation of machinery cause a delay in production? Now, based on these factors, you need to make a final decision. So in this case, I'm going to focus on the fixed cost as well. The fixed cost for option B has increased to 43,250, whereas the fixed cost for option A has decreased to 30,500. So in this case, due to the increased fixed cost for option B, I would suggest the directors to go with option A. Let's write it down. So the directors should choose option A, as the fixed cost for option B has increased due to the loan interest and depreciation on machinery. That is all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.